Now let's get in a little bit into premiums. There's so much here. I was amazed when I did my worked in accounting for a life insurance company. Just boy, this the minutia of details. They really do. It's extremely important in life insurance and property and casualty insurance to think about what these premiums mean because they have a dual role. One is their earn. It's revenue, but there's also the aspect of you're accepting risk when you write a product or you sell a product. You're getting revenue, but you're also promising to do something in the future. So it's both a revenue and a measure of risk, as we saw. We'll talk about the premiums to surplus ratio. But so when the policy is signed, you may not have any premiums yet, but you have written the premium. You have written the policy. You also have a date when the premium is actually due. Life insurance, that's a big deal for life insurance. Um, it's important for P&C as well, but it's more for life. Um, when the premium is actually received, that's the cash of the premiums. That's important, but it's not what's going to go into the financial statements. So when the policy becomes effective, that's when it's signed. We say that's when the policy is written. This is a P&C thing. P&C doesn't really worry about when the premium is due as far as an accounting like the life insurance side does. So when you sign the policy, the premium is 100% written. So if it's a 12-month policy, you've just written 12 months worth of premiums, even if you haven't received any. And this is what the premiums, the surplus ratio is based on, which if you think about it, makes sense because we're looking at risk. We're looking at how much net worth. Remember, surplus is the same as net worth. How much net worth we have versus our risk. Well, the way we measure risk in property and casualty is how much premium we've written. The more policies we write, the more risk we're taking on. And it makes sense that we would use written premiums because written premiums is when we're on the hook for this policy. It's not when we actually earn the premiums. It's not when we collect the premiums. When that policy is signed and we promise for the next 12 months, as long as you pay your premium, we're giving you insurance. That's when we've taken on the risk. And so we use written premiums to surplus as our measure. Now, over time, written premiums and earned premiums that we'll talk about a little bit later, written premiums and earned premiums are usually about the same, but for younger companies or companies growing fast, it's quite possible that written premiums can be much larger than earned premiums because you write the premium before you earn it. So over time, as the risk covered runs off, as the policy matures, you're earning that premium over time. So if you have a 12-month policy, you write the premium as of January 1st, you earn 1 month worth of premium as of January 31st. So you have, as January 1st, you have the entire 12 months premiums written, but 0 earned. After 1 month, you have 1/12 earned, and after 2 months, you have 2/12 earned. So here's an example. You sell the product on March 1st, so that's when it's written, or that's when it's signed. It's effective May 1st, so that's when it's written. It's a 12-month policy. So on March 31st, you sign the policy, but it's not in effect yet, so it's not written. Usually, you sign policies the same days as effective, but there can be a delay there. But it's the day that the insurance starts. So March 31st, there's nothing. On June 30th, you started providing coverage May 1st, so you have 2 months covered. So your written premium is the full $120. So as of May 1st, on May 1st, you have $120 of written premiums. Your earned premium is going to be $20. Your unearned premium is those months you haven't given them coverage for yet, which July through April. That's 10 months. So you have 10 months, $10 a month of unearned premium. So your earned premium, and this is a great equation to know, your earned premium is your written premium minus a change in unearned premium. So 120 minus 100, you've earned 20. Obviously, you can figure that out as it's $10 a month and you have 2 months there. But this is the actual equation that goes into the balance sheet. So unearned revenue, unearned premium is essentially unearned revenue. It's revenue that it's not quite the same as unearned revenue in a GAAP accounting for other businesses because that's usually like an apartment complex receives revenue at the beginning of the month. you pay your apartment rent at the beginning of the month. They haven't earned it yet. They don't earn it until the end of the month, so it's unearned revenue. But they've actually received the cash. With insurance, the unearned revenue is based off of the written premium, not based on what premiums they've actually received. And this is one way to bring written and earned premiums back into line is the difference is the unearned premium. Now you get to September 30th, your written premium is still 120 because that doesn't change. Your unearned is now 70 because there's 7 months left, so your earned premiums is 50. At the end of the year, your written is still 120. Your unearned premium is now 40 because there's January, February, March, April left. So your earned premium is $80. This is more interesting. You go into the second year, but so January of the next year, you start off with the year with a 70 unearned premium, and that's going to slowly, or wait, I'm sorry, 12/31. You have $40 in unearned premium. That's going to slowly dissipate over time, and so if this is the only policy you wrote, you would have the change in earned premium from one year to the next. Your written would be, as far as, let's do April, so this would be a good one to do. So as of April the next year, your written now is 0 because we assume there's no other policies in this one. That policy you wrote last year, so it's 0 minus a change in unearned premium. Unearned premium at the end of the year was 40, so it's now, that changes minus 40, and so you end up with $40 in revenue in the next year. So the next year gets a little more interesting, and it gets a little complicated because obviously they're going to write new business, including rewriting this policy. So it's kind of an ongoing cycle year after year after year. So when the policyholder pays the premium, that doesn't really have any impact on the income statement or the liabilities. It's just the liability set up based off of written premiums, not based on collected. There are other premium accounts. There's a premium receivable account. Essentially just showing that you have the written premium, but you haven't collected it yet, and so you have that as a receivable. Some people ask, why is there a premium receivable on an insurance company's books when insureds don't have to pay the premium? They can just not pay it and they lose the coverage. But we actually set it up because of that unearned premium reserve, because we're setting up the written premium in total for the whole year. So we're set up this large liability. We're allowed to set up this receivable on the other side to offset that, so we're not just knocking up the, really raising the liabilities of the firm. We'll talk about holding companies when we look at Allstate, but holding company, publicly traded insurance companies, they need to borrow money from capital markets, but it is very, very unwise to borrow money from capital markets or issue stock in capital markets from an insurance company, from a regulated insurance company. And so what they'll do is they'll have the holding company, which is not an insurance company, and it owns all the insurance companies. We'll see with this with Allstate. Allstate has a holding company. Now, USAA did not have a holding company because USAA is a reciprocal insurance exchange. As a reciprocal, the parent company has to be an insurance company, just the way it's set up. But USAA was not owned by a holding company, but they had a subsidiary that was a holding company. I was actually an employee of that company for a while, the USAA Capital Corporation. And so even though it was owned by an insurance company, it wasn't an insurance company, so USAA did all of its borrowing through its Capital Corporation, a subsidiary of their property and casualty insurance company. So even USAA, even though it can't have a holding company, it had a downstream holding company that owned the bank and the life insurance company, but it was a subsidiary of the property and casualty. And just because it's really awkward borrowing money from a regulated entity. Not that no one does it, but it's just very awkward to do that. Just because the regulators are so cumbersome in their requirements. I think we talked about the SNL, and this is not the comedy show, but the SNL, I forget what it even stands for, but they have other stuff on banking as well and other companies, but they have the entire statutory financial statements for all insurance companies back many years. All that detail, that 600 and something pages I was showing you for Allstate, and it's probably over 1,000 pages for State Farm. Just massive amounts of this database all the time. Very, very powerful. Okay, risk-based capital. We mentioned it a little bit before. Risk-based capital is how much net worth regulators and rating agencies think you should have. So they say surplus or your net worth that's the cushion you have against your risk. What risk-based capital does is it figures out how much you have in risk. It's essentially saying how much net worth you should have, and it assigns using formulas. It takes in consideration the mix of business that you have. It is still much better developed for the life insurance side than the property and casualty side. The original risk-based capital model was built by life actuaries, and they were quite technically competent individuals, and they did tremendous amount of kind of documentation and back testing to provide it's a really lengthy document. You should see what they created. The P&C side took what the life side did and just used most of it, and then when they got to the business side of it with the liabilities, the auto insurance, homeowners, they made some small tweaks and simplified it. Not quite as detailed, and probably not as accurate as either. So remember the categories of risk. C1 risk is your asset risk. It's not talking about the price risk of bonds related to interest rates, but it's looking at bonds from a standpoint of credit risk. That's why treasury prices do fall when interest rates rise, but they're looking at credit risk, the risk that they go insolvent. So you can see BBB bonds have a 1% charge. You have to have $1 of net worth for every $100 you have in BBB rated bonds. Junk bonds is 15%, so you have to have $15 for every $100 in junk bonds you have. Subsidiaries, if you have a subsidiary like Allstate owns a life insurance company, they may not let you count any of that net worth as part of your net worth. They may give you a 100% charge, so you essentially have to have dollar for dollar. And their argument there is that life insurance subsidiary needs its net worth to cover its risk, so you can't also count it to cover the property and casualties company's risk. There's also a concentration charge if you have too much invested in one entity. That's a really complicated calculation. I never had to do it, but I remember it's fairly complex. C2 risk is the insurance risk. It's just a factor applied to premiums and reserves. They've talked about a problem max of loss like we talked about. It's hard to do that in a formula that you have to apply to every company equally, so that's a little tough. I'm not sure where they are on that today, if they've made any changes. When I first saw the risk-based capital from the regulator side, there was nothing on problem maximum loss in the model at all, which is a big weakness. C3 is the interest rate risk. It's the risk that your bond prices fall when interest rates rise, or that your liability values rise when interest rates rise, so you lose net worth. Mainly a life insurance issue. I'm not sure there's anything there for property and casualty at all. It might be completely zero. And then C4 risk is a risk that you have because insurance companies are part of what's called the Guarantee Association. It's a lot like the FDIC for banks, where if you have insurance but the company goes insolvent, you go to the Guarantee Association and they'll pay any claims that you have, and then they'll get reimbursed from the insurance companies. It's a little different from the FDIC in the fact that the FDIC collects premiums from banks in advance of losses. Guarantee associations, they don't have anything in their coffers until there's a loss, and once a company goes insolvent, then they go out and they collect money from insurance companies. So it's a little bit different. So there could be a huge delay. If you have a huge auto accident and you're expecting tens of thousands of dollars, and right when it happens, your insurance company has gone bankrupt, it may take you a while to get your money back. The way they combine the risk is they take the square root of the asset risk squared plus the insurance risk squared. Well, I'm sorry. Let me do this again. So here's the actual formula. So they take the square root of, yeah, sorry, I was getting ahead of myself. Ignore what I just said there. I'll come back to that. But they take C1 and C3 risk and add them together and then square them. What they're saying there is these two have a perfectly positive correlation. So they're going to add them and then square them. Then they're going to add the square of the insurance risk. So the fact that they're squaring this and then adding that to the square of this. So they're not taking C1 plus C2 plus C3 and squaring them and taking the square root, because that would just be C1 plus C2 plus C3. They're taking C1 and C3 together and adding them, then squaring, assuming those two are perfectly positively correlated. And then they're adding C2 risk. When you add it separately like this and square it, you're essentially assuming the correlation is 0. So essentially they're saying insurance risk is uncorrelated to asset and interest rate risk. That's probably true most of the time, unless we had such a huge hurricane that it caused a worldwide stock market sell-off. We saw that with the Tokyo earthquake. That earthquake certainly caused a large sell-off in the stock market. But it bounced back fairly quickly. I don't remember what it did with interest rates, but it definitely bounced back fairly quickly. And so that's their logic. And we already talked about the reserve. Oops. Already talked about the reserve, and we did that example of the ultimate you expect to pay out of Part 2 minus how much you paid to date out of Part 3. So what we're going to do is we're going to walk through Allstate's financial statements. Look at a few things. I'll introduce a little bit of it to you, but just we'll wait till next session. I don't want to start here. We've been going 16 minutes, so I don't want to start right here in the middle and just have 2 minutes to get started. So let me just a little introduction. It's called the annual blank for the statutory side. You could call it annual report, but that's usually GAAP. The annual blank or the statutory statement is what the regulators required. You have to file it in every state that you're licensed to do business. My first job in accounting, I came in right when they were doing year-end financials. I was working in a life insurance company. They put us into a conference room, and we just spent the next several weeks putting together the year-end financials. And there's more to it than just putting together the statutory filing. There's also, each state has their own set of requirements that you have to fill out, and so we did the individual state requirements. Each of us would take 5 or 6 states a week and finish them. We just split it up among us. It was pretty fun. It was a lot of peer, just working together, good friendships. Just saying, hey, I'll do Nevada if you'll do Florida, that kind of thing. The lady I was there when I started in that department, had been there 30-something years. She knew which states were easy and which states were hard, and so sometimes she would give me a hard state so I could learn the stuff. Sometimes if a state was so difficult, she would just go ahead and do it herself, so I wouldn't have to mess with that. I think I remember Ohio was one of the bad states. New York was always a horrible state to do. They had so many extra requirements. In fact, New York requires you to file essentially an entirely another set of financials using their rules. It's pretty unusual. So on the property casualty side, we call it the yellow book because it's actually yellow. It has a yellow cover. On the life insurance side, it's the blue book. So life insurance is blue and property casualty, it's yellow. And you could actually, if you went into an insurance company and say, hey, I want to see the yellow book, they would know exactly what you mean. State law determines what your accounting is, but most states, New York's the one exception, require you to essentially submit 2 financial statements. But states use what's called some common accounting, statutory accounting. It's essentially the same in every state. There's a few differences. I'll show you a couple of differences. There's not many. So Texas files its according to the Texas rules for accounting, which might be slightly different in another state. And then they have to file that in every state, but they go by Texas rules. They don't have to have a yellow book for Texas, a yellow book for Florida. So once they prepared a yellow book, I remember we just had these stickies with the state names on them. We stuck them on the front of the book and mailed them out. So you file them with all the states. You file them with the NAIC, which is the National Association of Insurance Commissioners. We'll talk about them a little bit later. So what we'll do here this next time is we'll actually go through the financials themselves. I'm not going to work through the notes. I'm probably going to skip. Some of these are just some comments to let you know probably what I said when we were going through the financials. We've already done Schedule P, so we'll look at it again. We have a few things there at the end. So yeah, so our next session we'll get into annual blanks. So there's 2 you might want to have up and loaded, or you could watch it on the screen. The screen might be a little blurry. But there's the 686 page one, which is a PDF, which is the entire thing. There's a few times I'll jump over here. There's some interesting things I want to show you. And then there's another PDF that's just selected pages. And that's the 21 page one, and that's the one I want to walk through. You'll notice it's a little blurrier, so we might have to jump back and forth. The frustration with this is I didn't put page numbers. and you cannot trust the page numbers. So you'll notice it looks good at the beginning, page 1, page 2, page 3, but that quickly goes away. Further down, you'll notice there's page 5 and 5.1. Then we'll get to the general interrogatories and the footnotes, and that can be page 15.1 through page 15.45. So it's a little frustrating. I probably should have numbered them, but maybe we can find where we are. So we'll stop there, and next session we'll walk through a yellow book.